Listen carefully, because what I'm about to tell you separates the professionals from the perpetual losers in this game. You can have all the capital in the world, all the intelligence, all the determination, but if you're looking at the market through a single lens, you're walking into a gunfight with a knife. The market operates on three distinct time frames simultaneously, and your job as a trader is to master all three or get out of the business. I'm Jesse Livermore, and I didn't earn my reputation by accident. I turned $5 into millions, then lost it all, then made it back again. Not once, not twice, but multiple times across decades of trading. Some called me the boy plunger. Others knew me as the great bear who broke the market in 1929. But titles don't pay the bills. What pays is understanding one fundamental truth. The market reveals its intentions across three specific time frames: the weekly chart, the daily chart, and the 4-hour chart. Master these three, and you'll have an edge that 95% of traders will never possess. Ignore even one, and the market will drain your account without mercy. Before we dive deep into these three time frames that separate the professionals from the gamblers, I want you to do something for me. Check the description below this video. I've put together an ebook called Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. It contains everything I wish someone had told me when I was starting out, distilled into principles you can apply immediately. The link is right there in the description. Get it, study it, apply it, and if you haven't already watched my previous video, Why Higher Time Frames Always Win in Technical Analysis, stop right now and watch that first. It lays the foundation for everything we're about to discuss here. The link is in the description. When you're done with this video, leave a comment below telling me which time frame you've been ignoring, and check out the other videos on this channel where I break down the exact strategies I use to build my fortune. Now, let's get to the brutal truth. The first time frame is what I call the position time frame, and this is your weekly chart. This is your strategic view, your big picture, your North Star. The weekly time frame determines whether you should even be in the market at all, whether you should be thinking long or short, whether the conditions favor aggression or caution. When I look at the weekly chart, I'm identifying the major trend, the primary movement that's going to make you wealthy or keep you out of trouble. Here's what the amateurs don't understand. The weekly time frame isn't about predicting the future. It's about reading the present correctly. The market is always telling you what it wants to do. It's screaming at you through price action, through volume, through the behavior of leading stocks. But you have to step back far enough to hear it. If you're staring at a 1-hour chart trying to determine the major trend, you're like a man looking at a single brick trying to understand the architecture of a cathedral. I learned this lesson the hard way in 1907. I could see on the weekly charts that we were building towards something catastrophic. The signs were everywhere, if you knew how to look. Stocks were making lower highs week after week. Volume was drying up on rallies. The smart money was distributing while the public was accumulating. That weekly time frame told me everything I needed to know. Get short and stay short. That single insight made me $3 million while everyone else was getting crushed. But here's the critical part that everyone misses. The weekly time frame isn't static. It evolves. The market that's in a bull phase this week will be in a bear phase next month. Your job isn't to fall in love with your bias. Your job is to remain objective, to let the weekly chart speak to you without your ego getting in the way. I've seen more traders destroyed by their stubborn refusal to acknowledge that the weekly trend had changed than by any other single factor. When you master the weekly time frame, you gain something invaluable: patience. You stop jumping at every wiggle and jiggle in the market. You stop overtrading. You develop what I call patient aggressiveness. You wait for the market to align with your weekly analysis, and then when the moment is right, you strike with conviction. Not hope, not fear, but conviction based on what the market is actually doing across weeks of price action. The second time frame, and this is where it gets interesting, is what I call the timing time frame, and this is your daily chart. If the weekly time frame tells you what to do, The daily time frame tells you when to do it. This is where you're looking at the day-to-day rhythm of the market, identifying the specific moments when the major trend identified on the weekly chart is ready to make its next significant move. This is your tactical time frame, and it's where most traders spend all their time without ever consulting the strategic weekly view. Think of it this way. The weekly chart might tell you that we're in a bull market for steel stocks. That's valuable information, but it's not enough. Just because steel stocks are in a major uptrend on the weekly doesn't mean you should buy them at any random moment. You need the daily chart to tell you when the bull is ready to charge again after a rest, when the consolidation is complete, when the spring is coiled and ready to release. I use the daily time frame to identify what I call pivotal points. These are the moments when a stock breaks out of a consolidation pattern on the upside with strong volume, or when it fails a rally attempt and tells you the timing isn't right yet. The daily time frame is all about precision. It's the difference between buying a stock at 50 based solely on the weekly trend and watching it immediately drop to 45 versus waiting for the daily chart to show you the proper setup at 52 after it's proven it's ready to run to 70. Here's a critical insight. The daily time frame must always align with the weekly time frame. If your weekly chart says we're in a bear market, but you see a bullish setup on your daily chart, you ignore it. That's a sucker's rally, a trap for the unwary. The daily time frame only gives you valid signals when it's moving in harmony with the major trend identified by your weekly chart. Violate this principle, and the market will teach you an expensive lesson. This is exactly why I created that video, Why Higher Time Frames Always Win in Technical Analysis. If you missed it, go back and watch it after this one. It explains in detail why the weekly chart is your compass and why fighting it is financial suicide. The daily time frame is also where volume becomes absolutely critical. Price can lie to you, but volume rarely does. When I see a stock breaking to new highs on the daily chart but volume is declining, that tells me something important. The move lacks conviction. The smart money isn't participating. It's a false signal, and I stay away. But when price and volume align on the daily, when a stock breaks out on explosive volume after a proper consolidation, and this aligns with the weekly trend, that's when the daily time frame is giving me the green light. Now we come to the third time frame, and this is the one that causes more confusion, more losses, more psychological torture than any other aspect of trading. I call it the entry time frame, and this is your 4-hour chart. This is your execution window, your moment of truth, where you're looking at the intraday rhythm to get the best possible price on your position. And here's what kills most traders. They use the H4 chart to make decisions that should be made on the weekly and daily time frames. Let me be crystal clear about this because your financial survival depends on understanding it. The 4-hour chart is not for analysis. It's for execution. By the time you're looking at the H4 chart, you should already know from your weekly chart that you want to be long or short. You should already know from your daily chart that now is the right moment to act. The H4 chart is simply about identifying the precise entry point and minimizing your risk. But what do amateur traders do? They open up their H4 chart, they see some pattern forming, and they make a trading decision based solely on that. They completely ignore what's happening on the weekly and daily charts. It's like a general sending troops into battle based on what one scout saw in the last 4 hours, ignoring all the intelligence gathered over weeks. It's suicide, plain and simple. I'll give you an example from my own trading. Let's say my weekly chart tells me that the railroad stocks are in a major bull market. My daily chart shows me that after a week of consolidation, they're ready to break out. Now I move to my H4 chart. I'm watching the 4-hour candles, looking for the precise moment when the stock shows strength, when it's pulling back slightly but holding above key levels, when the weak hands are being shaken out before the next leg up. That's when I execute. I might wait several 4-hour candles, watching patiently, for that exact moment when the odds are stacked most heavily in my favor. The H4 chart gives me 2 critical advantages. First, it allows me to minimize risk. If I'm buying a stock at 52 based on my daily chart analysis, but I use the H4 chart to wait for a precise pullback to 51.5. I've just reduced my risk without changing my overall position. That might not sound like much, but over hundreds of trades, that discipline adds up to millions of dollars. Second, the H4 time frame shows me immediately if I'm wrong. If I buy at 51.5 and the 4-hour candles immediately break below 50, I know something has changed. I get out quickly, taking a small loss rather than hoping and praying and eventually taking a catastrophic loss. Here's the brutal truth that nobody wants to hear. Watching all 3 time frames simultaneously is hard. It requires discipline. It requires you to slow down when every instinct in your body is screaming at you to act. It requires you to sometimes watch incredible opportunities pass by on the H4 chart because, while the entry looked perfect, the weekly or daily charts weren't aligned. I've had to sit on my hands countless times, watching stocks rally without me on the 4-hour chart, because the 3 time frames weren't in harmony. And you know what? Every single time I violated this principle and jumped in anyway based on what I saw on the H4, the market made me pay. The 3 time frames work together like gears in a precision machine. The weekly chart identifies the trend. The daily chart identifies the wave within that trend. And the H4 chart pinpoints the exact entry within that wave. Miss any one of these, and the whole machine breaks down. You end up being a trader who's right about the big picture on the weekly but wrong about the timing on the daily, or right about both but so sloppy with your H4 execution that you get stopped out before the move happens. Let me tell you about 1929. Everyone focuses on the crash, on the short position I took. But do you know what made that trade work? It wasn't genius. It wasn't some mystical ability to predict the future. It was the 3 time frames. My weekly chart had been telling me for months that we were in a speculative mania that couldn't last. The signs were everywhere. Stocks trading at absurd valuations, margin debt at record levels, every shoeshine boy giving stock tips. The weekly said, "Prepare to go short." But I didn't short immediately. I waited for my daily chart to confirm. I waited for the market to show me that the top was in, that distribution was complete, that the smart money had exited. And then, only then, did I use my H4 chart to execute short positions at the most advantageous prices possible. That's how you make history in this game. That's how you survive when everyone else is getting obliterated. You respect all 3 time frames. You wait for alignment. You trade like a sniper, not a machine gunner. One perfect shot, properly set up, is worth 1,000 impulsive trades. Now, I see some of you nodding along, thinking you understand. But understanding intellectually and implementing practically are 2 entirely different things. This is where most traders fail. They know they should check the weekly, daily, and H4 charts, but when they're actually in front of the screen, when the adrenaline is pumping, when they see a beautiful setup on the H4 chart, they abandon their discipline. They tell themselves, "Just this once," or "This one looks too good to pass up." And that's when the market takes their money. You want to know the real secret to using the 3 time frames? It's not about some complicated system or indicator. It's about developing a routine, a checklist that you follow religiously before every single trade. Weekly chart. What's the major trend? Am I aligned with it or fighting it? Daily chart. Is this the right moment within that trend to act? Has the stock proven it's ready to move? H4 chart. What's the precise entry point that minimizes my risk while maximizing my potential reward? That checklist saved me more times than I can count. It kept me out of trades that looked brilliant in the moment, but were actually traps. It forced me to be patient, when patience was the last thing I wanted to exercise. It made me money when everyone else was losing theirs. Here's what I need you to understand at a deeper level. The 3 time frames aren't just about technical analysis. They're about psychology, about managing your own mind as much as managing your capital. When you properly use the weekly, daily, and H4 charts together, you create emotional distance from the market. You stop reacting and start responding. You stop being a victim of every price swing and start being a professional observer and participant. The weekly chart gives you perspective. When you're looking at weeks of data, When you can see the bigger pattern, you don't panic at every down day. You don't get euphoric at every up day. You maintain equilibrium because you understand where you are in the larger cycle. I can't tell you how many times I've watched traders destroy themselves because they had no perspective, no weekly chart to anchor them. They'd be bullish one day based on a good morning, bearish the next day based on an afternoon sell-off. They were leaves in the wind, and the market blew them away. The daily chart gives you confidence. When you've done the work, when you've identified a proper setup on the daily that aligns with the weekly trend, you can execute with conviction. You're not guessing. You're not hoping. You know that the probabilities are in your favor. That confidence allows you to size your positions appropriately, to hold through normal volatility, to actually make money when you're right. Without the daily chart, you second-guess everything. You exit too early. You enter too late. You leave money on the table even when your analysis is correct. The H4 chart gives you precision. This is the difference between being a profitable trader and an exceptional trader. It's where you demonstrate mastery, where you show that you're not just some gambler but a professional executing a carefully planned strategy. Every point you save on entry using the H4 chart, every point you gain on exit compounds over time. The H4 time frame is where discipline meets opportunity, where patience meets action. But here's the part that separates the legends from the forgotten. You have to be willing to walk away. Even when the weekly is trending, even when the daily shows a setup, even when the H4 looks perfect, if something doesn't feel right, if the market isn't acting the way it should, you walk away. I've aborted more trades at the last second based on what I saw on the H4 chart than I can remember, even when everything looked perfect on the higher time frames, because something in the price action told me the setup wasn't as good as it looked on paper. And every single time, the market proved me right within hours or days. The market rewards those who respect it, who approach it with humility and preparation. The 3 time frames are your preparation. They're how you stack the odds in your favor in a game where the odds are naturally against you. They're how you transform yourself from an emotional gambler into a calculated risk-taker. I want to be very direct with you now. If you take nothing else from this video, take this. Starting tomorrow, before you make any trade, check all 3 time frames. Write them down if you have to. Weekly chart. What's the major trend? Daily chart. Is this the right moment? H4 chart. What's the precise entry point? If you can't answer all 3 questions clearly and affirmatively, do not take the trade. I don't care how good it looks on the H4. I don't care how much you want to be in the market. You wait until the weekly, daily, and H4 all align. Do this for 1 month. Just 1 month. Keep a journal documenting every trade you consider and which time frames supported it or didn't. I guarantee you'll see a transformation in your results. You'll take fewer trades, but the trades you take will have a higher success rate. You'll sleep better at night because you'll know your positions are based on sound analysis across multiple dimensions, not just hope and impulse. And when you inevitably have losing trades, because you will have losing trades, the 3 time frames will protect you. They'll keep your losses small because you'll know immediately when the market is telling you that you're wrong. You won't ride a position from a small loss to a catastrophic loss because you'll have clear exit signals on your H4 and daily charts. The weekly chart will tell you if the entire premise of the trade has changed, and you'll exit completely rather than averaging down into a losing position. This is what it means to think like a professional, to trade like someone who's going to survive not just the next trade, but the next 100 trades, the next 1,000 trades. The market is a marathon, not a sprint. The 3 time frames are your pacing strategy, keeping you from burning out in the first mile or giving up before the finish line. Before I leave you, I want to remind you to check out that ebook in the description, Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. Everything we've talked about today is expanded there with specific examples, specific strategies, specific tools you can use immediately. Get it, study it, master it. Your future self will thank you. And do me a favor. Leave a comment below. Tell me which of the 3 time frames you've been ignoring. Tell me your biggest challenge with multi-time frame analysis. I read every comment, and your insights help me create better content for this community. Also, if you haven't watched my video, Why Higher Time Frames Always Win in Technical Analysis, go watch that next. It's the perfect companion to what we've covered here today. And don't stop there. We have other videos on this channel that dive deep into specific trading strategies, psychology, risk management, all the tools you need to succeed in this business. Watch them. Learn from them. Apply them. The market is the most brutal teacher you'll ever encounter. It doesn't care about your feelings, your needs, your dreams. It will take everything from you if you let it. But if you approach it with the right tools, the right mindset, the right respect, it will reward you beyond your wildest imagination. The 3 time frames are your foundation. Build everything else on top of them, and you'll have a trading career that lasts, that prospers, that gives you the freedom and independence that drew you to the market in the first place. Now get out there and put this knowledge to work. The market is waiting, and it rewards those who come prepared.